everybody. Welcome to Friday, another Talk Money with Tom show today. What we do on this show is just try to help you have a better retirement, especially financially. We do that by answering your questions. So you can send those questions in now if you'd like to the email address that's listed here, the Ask Tom at talkmoneywithtom.com email. You can send those during the week also. We do get those, and it gives us some more time to think about them and maybe answer them more completely. But you can also put questions into the chat box if you'd like. We're here to basically answer questions about how to manage your money in retirement or up to retirement and get ready for it, how to plan out your retirement, the retirement planning aspect, and then really try to handle your taxes and reduce your taxes through tax planning over the long term. And so we really believe that the more you can learn about these three subjects, the better your retirement possibly can be. It's why we created this channel. It's why we're putting out this content. And so if you'd like to subscribe to the channel, you can do that. We have over 900 videos currently on the channel that you can peruse. And then, of course, if you want to get notified when we put new content on, you can hit the bell button and get an email for that. So the last thing I'll mention is just if you'd like to book an appointment, you can do that also. You can go to our website. There's a book appointment button up in the corner. Set up a 30-minute time that works for you. You can meet with Eason and I, and just maybe have a custom question or something that we can handle on a one-on-one basis as far as that goes. So hopefully today you get something good out of this. You find some question that kind of makes you think, or you learn something for the future as far as that goes. There's a lot to be learned here. It isn't something that's taught in school. It's why we have this channel as far as that goes. So looking forward to being able to answer your questions. Start sending them in now and get us a chance to book up those questions. I do like to start off the week with a kind of a summary of what I saw happening this week in the market. I have a chart here of the S&P 500 year to date. And so you can see, obviously, we've had a downturn. We hit a low here in middle of June. We've had a pretty nice run up since then, actually. That blue line that you see here is the 200-day moving average. So to me, that's fairly important. Two pieces there. Number one is it's going down, and the price is under the 200-day moving average. To me, that's the definition of a down market. So the major trend is down, and this uptrend that we're having is a bounce on a down market, or possibly a new uptrend that starts and turns the major trend to up. And so I've got some things that I'll show you. That's what we look for before we decide that this trend has reversed, because we do different things in different markets. We have one investment concept that works in a trending upward market, another one that's going in a sideways market, and one that works in a down market. So those are our three things. Right now we're using our down market methodology until we start to see this entire thing change. You can have these very large run-ups like we've seen here. As a matter of fact, if you look on the chart there back in March, we had another big run-up also. You can have those in these rolling down markets like we had in 2000 and 2008. So you have to be very careful to get sucked in there and think it's all over. And I'll show you some of the things that we look at. But this week was very interesting because if you look back to March, when we had that big run-up, and if you look right after March, it basically went straight down. And what happened then was that the Federal Reserve started coming out and doing all of these interviews in the first week of April, talking about how aggressive they were still going to have to be to fight inflation. Because you got to understand that the Federal Reserve really has trouble with a stock market that's doing very well in a high inflationary environment, because it just makes money more available. It increases the likelihood that you'll have more inflation. It makes their job harder. So they start to come out and make aggressive statements and hope to scare the market back down. And that's what they did this week, just like they did back in the first week of April. But the difference was the market didn't drop. It stayed up as far as that goes. So that was really important, I think, as far as that goes. And then today we had the jobs report came out. And this is one of the great ironies right now. The expected number of new jobs was 258,000. And we ended up with 528,000 new jobs. So normally that's good. Market would respond positively to that. But when you have inflation running at currently 9.1%, that's a problem, especially because the average wage increased by 5.2% over the last 12 months and 0.5% to 0.5% over the last month. And what happens if when wages are going up and when lots of jobs are being created, the market gets very hot in the labor market, and all of a sudden, companies are having to pay more for their employees. They pass that along sometimes as a higher price to the consumer, which again makes things more expensive for the employees, so they want more money, and that's this wage cycle, inflation cycle that they talk about. And so that was a concern today. But if you look very closely at the last little bar here, it actually didn't fall out of this range today. It's been kind of a muted response to what could have been a bad report to the market as total, because now the Federal Reserve is looking at probably having to raise rates at a faster rate. So the expectation was next meeting September, 0.5%. Now all of a sudden the expectation is 0.75% again, which would be 3 of those in a row. And the danger, of course, to the market as a whole with these rate increases is that they are delayed in their impact. So they raised rates in September. You might not see the true impact of that until March of next year, 6 months later. And so that's where you get into the risk zone, because the Federal Reserve keeps raising rates based on all these things that are happening, and eventually things do start to slow down. But of course, the impact continues forward, and all of a sudden you're in a deeper recession than expected, and the Federal Reserve has to run and make an adjustment and start to lower rates again. And so that's kind of what the market has been expecting, is that the Fed would be lowering rates by February. I think this job report probably pushes that out some as far as that goes. So that's kind of what's going on. But what I'd like to cover now is just some kind of the technical areas that I'm looking at. So technical analysis is essentially the study of charts, volume, resistance, support levels, moving averages, all of these different types of things. And I'll just show you kind of some of the things we're looking at, because I think it's very interesting where we're at right now and kind of the importance of that. So first of all, I drew a line in here that is both a support and a resistance line. If you look back to earlier in the year, we bounced off of that line and actually had that big run up in March. So that was support. It jumped off of that. Eventually we broke through that, and then you can see here in kind of June where we hit into it. We ran into it for 8 days in a row before we fell. And now we've done it again. This is the 6th day in a row. We're running into that same resistance. We haven't been able to break through it. It is quite important, at least for the total recovery of the market, to be able to break through this. And so we'll see what happens. On the other hand, if you look at kind of the support side right now, there's a lot of support just below where we are. So we're in this little channel. And so you can see we're bouncing around just like we did back in early June. And one of the things I always like to tell people here is that you have to be really careful. Yes, the market has had this big run up, but right now the market is just trading inside this little range. So if it goes up 1% or down 1% and it doesn't move out of this range, that's not useful information. I always look for information from the market. If it breaks above or below, that'll be useful information. If it's just bouncing around, like even today, yeah, the jobs report came out, but we're still in that range. So I'm still not getting the info that I need to be able to decide what I might be able to do next. So for example, if we break below that range, we're going to fall most likely into this zone right here. This is the next support level as far as that goes. This little area, this light yellow area that I put in there. That's about 5% below where we are now. And if we fall below that support, we're going to set a new low. We're going to go below where we went, most likely, because there's not a lot of support below that. We're most likely going to go back down to a low below where we were in June, right? So that's information. We're still inside that little zone, as I pointed out here. And so until we break below that, again, I'm not sure what's going to happen. You have to be patient here. So it goes below, we got that zone. If it goes above, here's the zone above. And so this is kind of, again, about 5% above where we are. Could have a nice run if we break through. And now we're starting to really start to check the boxes for turning this into a major uptrend instead of just a minor uptrend, right? Because the major is still down right now, below the 200-day moving average. 200-day moving average is going down. But the checks, you make check boxes as you start to recover, just like we did in 2020. And so one of the things is to get through this first resistance level and then get into that next resistance zone, right? So then if we can get into that zone and break out of that zone, there's quite a few things happening all at once. I just drew a trend line there across the top. So go back to January. That was the all-time high for the S&P 500. Cross the top of what happened at the end of March. And if you look, we've got that yellow zone. We got the 200-day moving average, which can be resistance also and support if we can get through it. And we have this trend line. If you move forward a couple weeks, those are probably all going to converge at roughly the same spot. Probably about 4,300, 4,400 zone for the S&P 500. And so what's happening there is that's a huge issue. If we can get into that and through that, it's likely that we're actually going to start to go towards a new all-time high sometime in the second half of this year. But we've got a long ways to go. And again, as long as we're in this trend right now of just kind of going sideways, you can't really make an assumption that we're going to go crazy to the upside. And you can't make an assumption that we're going to fall apart either. So our status right now is we have, about 20% of our stock allocation in T-bills right now. And the rest is exposed to the market, which has worked out well on this upside. Could have made more if we had all of it in. But because of what's happening with all the different signals for possible recession, the Federal Reserve's aggressiveness and all those things, we're still maintaining a conservative standpoint. If we break above some of these areas, we'll start to reduce our T-bill exposure. If we fall back below, we might even increase it. We'll see what happens, depends on where it goes. So that's what's going on right now, just kind of on a broad technical basis. There's lots of different things we look at, but I just wanted to share kind of how this works, especially these support and resistance levels, which can be very, very important, in the short term especially. So that's what's going on. Look forward to being able to talk to you again next week and discuss, what's happening with the market. All right, Eason, let's go with the first question here. What's on deck?
So the job report came out. I heard it's called a lagging indicator. What is a lagging indicator?
Okay, sometimes it's easier to describe a leading indicator. So a leading indicator leads the economy. So the S&P 500 is considered a leading indicator. It's part of the leading indicator basket that they use. So it's moving before the economy moves, and it shows you what might be happening, right? A lagging indicator is just the opposite. It's something where the economy is already moving, and it can still be going down. So, for example, oftentimes you'll see the economy recovering when you're hearing about a lot of unemployment reports and higher unemployment happening. And that's because it takes so long to get to layoffs, right? And so finally get to layoffs and get people out of there, do the severances, all these things. They end up on the unemployment report. And already, the economy has already started to turn around because that took 3 months maybe to get those people out. The opposite happens when the market's going, the way it's going now with the job market going up. So the job market is still going up and the economy is actually softening. So it's not that useful of information. And that's the problem for the Federal Reserve. You can't look at a lagging indicator and then put up the interest rates to a higher level, right? So that's a lagging indicator.
So the next question, we have a couple questions on the Inflation Reduction Act. The first question is, with Sinema agreeing in principle, should I be buying clean energy and electric cars or companies?
Yeah, we did. So last week, clean energy jumped on the news that there was some possible agreement on this, Inflation Reduction Bill, and but it was for a variety of reasons. I wasn't positive that this thing was going to pass, and still we're not, right? I mean, it is nice that the two senators on the Democratic side that normally, are the hardest ones to get through, both seems to have agreed that this is going to happen, and so that helps and maybe gives some more confidence towards that area. But the main reason that we bought our clean energy ETF was because it has been, on a relative basis, making more than the overall stock market since the invasion of Ukraine on the 24th of February, which makes sense. And that trend isn't going to change. So Europe is trying to get off of Russian oil, natural gas, and coal. One of the solutions will be clean energy, wind, solar, and whatnot. And so these companies are in front of the possibility of some money, because it's not just going to be the U.S. that's looking to put money like they are here with this bill into clean energy. It is Europe. China's already working on it. Everybody's looking at this, in my opinion, and going to start to think, man, we need to get to a spot where we have our own energy that we control and that we're not getting from some other country who could all of a sudden become, a country we don't want to deal with. So, yeah, I think clean energy is a good bet here. The problem is that they're still fairly overpriced. When you dig into these ETFs or you dig into these individual holdings, a lot of times they're still pretty expensive versus earnings. So in this market environment, it's a little bit of an aggressive move to be in those, high PE ratio stocks. But I do like the relative strength that they've been showing recently.
What about electric cars and those companies? Because electric cars are a little bit harder to invest because there's not a lot of pure plays, I would say. Like you can think about Ford. Ford also has their gas and then electric, or most of those major kind of car manufacturers have mixed.
Yeah. General Motors has a fairly big presence in electric, but obviously has an awful lot in non-electric cars. And so, how do you play those? Generally speaking, when you see a electric vehicle ETF, they'll have a lot more exposure to the universe of different pieces, the battery makers and the companies that are making the little inverters that make solar cells. Better is a big one that fits in those regular clean energy ones. And so the plug power things, we've got to plug these cars in somewhere at the Target and New Mexico or whatever it is where we're traveling. So that type of thing is the more pure play. It's tough, and those will be included in those electric vehicle ETFs, and that's how they do it. Because otherwise, you'd have Tesla, basically. There are a couple of other pure plays, internationally and whatnot too. But Rivian, I suppose, is another one, right? And so it's a really limited list. You'd have a very small ETF, and the way that they do that is just spread it into the ecosystem of that whole arena, all of the different pieces. And I actually like spreading it even farther. We'll call it clean energy. Put the car stuff in there and the wind stuff and the solar stuff. I like that more diversified clean energy piece. Once you start really narrowing it down, if you watch those, they can get a lot more volatile. The pure solar, ETFs have been, they're fantastic sometimes, and then they're really, really can be aggressively to the downside when things aren't going right. So again, a lot of these things are overpriced on a relative basis. Tesla would be in that category. It's selling at a pretty high multiple times its cash flow, et cetera. So.
Yeah, talking about those solar ETFs, like earlier this week, I forgot the name. Was it Solar Edge? Basically had a pretty abysmal earnings report, and the market didn't take kindly, and they dropped like 15 to 16%, and all the solar ETFs got hammered.
Yeah, and that Solar Edge actually was selling at 78 times earnings. The average market right now is around 18, I think. So that's very expensive. And so if you miss your earnings, people are paying that extra premium for a company like that because they're growing so fast. And all of a sudden you realize they're not. You're going to take a big hit to the stock price. And so that's where the risk stands. At certain markets, nobody cares about the PE. 2020 is a good example. It didn't matter. Companies didn't even need earnings. They were selling at 300 times their revenue. Just crazy stuff. Same thing we had in 2000, right? But this market's much more reasonable, much more focused on cash flows, which is not an unusual scenario when the market is down. People are being less risk, taking less risk as far as that goes. So that'd be my only real big caution about over-investing in this category. It's just they are still fairly expensive.
So the second question on Inflation Reduction Act was, how does the tax on share buybacks affect the market?
Yeah, part of the negotiated settlement at the moment that we're hearing about, and again, keep in mind that none of these things we're talking about have been signed into law yet, so who knows what happens. But part of it is to tax share buybacks at 1%. So, Apple's buying back $90 billion worth of stock a year right now. They'd have to pay a 1% tax on that. And, it's not taxable right now. And one of the reasons they do buybacks is because they have excess cash and they got to figure out where to put it, right? Where do they put it? Do they put it into buying their own stock back? When they buy their own stock back, they reduce the number of shares. If earnings stay the same, all of a sudden their PE ratio, the price to earnings ratio, gets lower. And sometimes the market will drive it back up to where it was. And so that's what you're trying to do when you're doing buyback, is to increase the price of your stock. And so buybacks are really big. There's a tremendous amount of money going to buybacks. You can put it out as a dividend, right? Mm-hmm. Where people might buy that stock because it pays a higher dividend, and that might increase the price. Buybacks seem to be more popular or more effective than dividends, just via the fact that there's more buybacks happening than increased dividends. I mean, it's financial engineering if you just kind of look at what's happening. The other thing, of course, you can go do new projects, new growth, open up new stores, find new, so Apple Car, for example, for Apple, but you'll see all of these happening. You'll see, but a lot of money is going into buybacks. So if you start to tax buybacks, number one, the market's probably going to react negatively to that, just because that is part of the reason the market's doing so well, is because these buybacks are happening. And if you add cost to that, it'll change the financial engineering answer, and maybe, according to some of these reports, you'll see a higher dividend, right, which doesn't usually have as much impact on the price as buybacks has.
Right. So the Brookings Institution from their tax policy center had a report that says like a 1% share buyback tax. They published this in December of last year, would increase dividend payouts by about 1.5%.
Yeah.
And the reason people like buybacks over dividends is you get a lot less bad publicity if you cut your buyback program versus cutting your dividend.
Yeah.
So if your dividends go down, the market does not like that at all.
Yeah, just ask AT&T. Oh, mackerel, they got hammered with their dividend cuts. And yeah, you're exactly right. I mean, almost nobody says anything. If Apple went from 90 billion to 50 billion in their buybacks, people probably wouldn't even know for the most part. If they cut back their dividend by 10, 15, 20%. Apple's not a great example because they're not a huge dividend stock, but it's just a redirection. It's going to force a redirection into a less efficient area, theoretically, from a financial engineering standpoint. However, some of that could be forced out into new product development that isn't being done now. So that might be kind of interesting to see how that plays out. I mean, you get these companies, they just have so much cash flow, they can't find enough projects that they can get the rate of return on that they need, versus, hey, Apple's basically saying we're better off taking 90 billion and buying back our stock than putting 90 billion into the Apple Car or whatever it is, just because it's more certain what we're going to get out of it over here, versus these are very uncertain, right? But at the same time, the more of these projects that get started, some of them are going to work, and some of them have been radically good for the economy, for employment. And so, that could be good, but that's more of a longer term thing to see how that plays out. In the shorter term, I would think the 1% increase on the tax, 1% tax on the buybacks is going to be a negative to the market and probably respond negatively to that. So we'll see how it plays out, but it's interesting. I don't have a huge problem with it, especially if it funds some of these other things. It's not a terrible concept, but the question was how it would affect stock market. I think it'll be negative, at least in the short term.
Yeah, it's because you have about 900, or I think it's $882 billion of buyback last year, and so if you tax just 1% of that, you're generating a lot of money.
Yeah.
And so it pays for stuff, but maybe the calculation is different and lowers that. So say you need a 15% return because buybacks get you that, but if you drop that to 12%, maybe more projects are viable.
Yeah, exactly. I don't know. If you look at the negotiations that have gone on in that bill, the one thing that kind of mystifies me is that they were going to close up a little bit of the loophole on this carried interest, which really only affects the very, very wealthy, specifically hedge fund managers and what have you. Just the way that they're able to declare gains in a certain manner that would normally be income tax at ordinary income levels. They're able to cap that out at 23.8%, and they're trying to fill that, and so they decided we're not going to do that. So we're not going to tax hedge fund managers. We're going to tax, and they replaced it with a tax on share buybacks. That doesn't seem like a good trade to me. That seems like somebody has a better lobby than somebody else. I don't know, but that's kind of interesting as far as that goes, and essentially come down to one senator, deciding that this was going to happen, and it could have an impact. So we'll see how this plays out.
Yeah, and I feel we'll get more further confirmation really rapidly because they're pressing this bill quite rapidly through Congress.
Yeah.
And so maybe in a couple of weeks we'll have the actual bill that's going to get signed.
Yeah.
And we'll know for definite purposes.
Yeah, they're heading into August break, right? So I think they're going to try to get this through before that. It has to go through the parliamentarian, I believe they call it, who decides whether some of these things can actually go through the reconciliation process, where they only need 50 votes instead of 60. Some of these pieces might fall off during that period of time. Probably not the tax on the buyback, but
it seems a lot of this stuff has some sort of money value associated with it. So most likely, the only one that could get weird is the negotiation of as a group for your prescriptions. Is that a budget item?
Yeah, that's right. Yeah, they try to squeeze through everything they possibly can because they can't get 60 votes on either side. So we'll see how this plays out.
So next question is, how does a strong U.S. dollar affect the stock market? And are there any industries that kind of perform better in this environment?
Yeah, I read a really good article breaking down the problem with the dollar. And the last time we had really significant problems with the dollars was in the 70s for the same reason. When you raise interest rates dramatically, all of a sudden your treasuries are paying more, and the rest of the world wants to buy those treasuries, and they're converting their currencies and they're buying dollars to do that, and so it drives the price of the dollar up. And that's fine up to a point. You want strength in the dollar, but you don't want too much strength in the dollar. Because what happens is companies that are in U.S. companies that are selling internationally, all of a sudden their products get way more expensive. Their profits can drop in that environment. Their revenues can drop in that environment. The S&P 500 has 40% of its sales coming from international sales. So those companies that have high exposure to that international sale, their products are getting more expensive because the dollar is growing versus those other currencies, right? So if it really, really runs, it would be a pretty big problem. Watch how much the market starts to react positively if the dollar runs super strong. It has actually backed off just recently off of its highs, so things are looking better than they were even just a few weeks ago as far as that goes. If you're traveling, right, that's great. You go to Europe, it's cheaper, got this parity, more or less between the euro and the dollar, which we haven't seen in 20 years. And so, if you're buying things, so that's where that's the advantage side. That's where the companies could make more if you're buying things internationally and selling them here, or producing them internationally and selling them here. If you're selling to the U.S., like you mentioned earlier, like Walmart, when we were talking about this earlier. So they go out, they're buying things internationally and bringing them in and selling. So it's getting cheaper to buy those things, and that's good. And that brings that in. They can either have a higher profit margin or reduce the cost to the customer. Country, like let's say a company in Europe that wants to sell something here, they're going to be cheaper because the euro is now lower, and they, so it depends. If you're coming the other direction, that's the advantage. I haven't seen a lot of great gains. I mean, Walmart's struggling with inventory issues and overall inflation that's causing, because they have very thin margins. And so, it's really easy with the higher wage cost increases to really disrupt those margins. And we saw Walmart's, report that came out this last quarter was off by, quite a bit. And so, it hasn't helped them so far. And of course, say a European country trying to sell, Europe's struggling. So you're going to buy the European stocks. Those stock markets are really still struggling. You got some giant hedge fund managers with very good track records all shorting Europe right now. They might be wrong, but there's a reason they're doing that, because there's an expectation that Europe's going to suffer more because of this Ukraine situation and the reliance upon this Russian energy, which has gotten more expensive. Or potentially, actually, oil's to come back under $90 a barrel now. It's kind of incredible. But has potential to be an issue, right?
Yeah, and we've seen it with the earnings reports. Many companies are saying that, we're revising our guidance because the strong U.S. dollar is hurting our exports to other countries. Yep. I think you mentioned earlier that 40% of revenue for S&P 500 companies comes outside of the U.S.
Yeah.
And so it's rough. Like Solar Edge that I talked about earlier, how it dropped 15 to 16%, was a lot of that was because they revised guidance because 30 to 40% of their revenue is from Europe.
Yeah.
And so selling products in Europe just became their margins go down.
Yeah, if they're competing with another solar company that has a similar product, for example, that's in Europe, their product just got more expensive versus that European product. And even if they keep it at the same price as the European ones, they're actually losing more money because they're because of the exchange. So again, if a dollar gets really strong, it could be a real big problem. And as they keep raising rates, that has more and more potential to create a stronger dollar, especially if we're raising rates at a faster rate than other countries in the rest of the world. If you can, just to make up a number, if you can get 8% Treasury here and 5% everywhere else, where are you going to get here? You're going to come here. This is one of the best places to have a Treasury. This is the safe haven, and it's paying more. And so people from around the world are buying Treasuries, and they're making the dollar values go up, right? So, very, very interesting time frames. Part of the consequence of this high inflation.
So now we have a planning question. How much of my income do I need to replace when I retire? Do I have to replace 100% or can I just replace a portion of it?
Yeah, this comes up all the time. People are trying to figure out what their retirement's going to look like, what it's going to cost. A lot of times people don't know what they're spending now, right? So they got to start there, figure out what they're spending now, and go through that and make sure we don't miss anything major. Some things only come once a year, and, making sure that we're not looking at the bare minimum because there's lots of surprises that come along. I have 3 dogs, 2 kids, and 5 cars. I get a lot of surprises. Right? Stuff keeps coming to the point where you kind of have to budget for it. So let's say, just for example, that somebody has $100,000 worth of income now, right, in gross, and they want to know, well, how much am I going to need in retirement? Well, first of all, first question I always ask, especially for somebody that's getting closer to retirement, is how much are you saving into your 401k? So let's just say that person's saving $20,000 in 401k. They're not going to do that anymore. So they're really living off of that $80,000. So a lot of times people kind of just maintain the same standard of living that they had prior to retirement. So that standard of living is $80,000, right, versus $100 that they're making. So now we've got a number down to 80, and then oftentimes we have a scenario where there'd be less tax, right, for a variety of reasons. I mean,
yeah, you have your FICA taxes, so you have your Social Security and Medicare, and that's 7.65% of your income, and FICA tax is always taken or for your total paycheck. So even your 401k contributions have that FICA tax still taken out.
Right. And so you won't have that because that's an employment tax and you're no longer employed, you've retired. And you'll probably save other tax dollars, especially in the first part of your retirement, because you might be able to take money from assets that have capital gains tax instead of ordinary income. And so let's just say, for example, that 100,000 saves 10,000. So we save 20,000 in savings, in this hypothetical case, but that's what you'd want to figure out, how much are you actually saving, at that point that you can take out another, say 10,000 in this case, 10% for taxes. Now we're at 70,000, right? So now you want to look at kind of the different things that are going to happen in retirement, because now every day is a weekend. And I don't know about you, but I tend to spend more money on the weekends. I'm too busy during the week. I'm working all the time, and now I'm retired, let's say, and I've got hobbies or travel or whatever it is that happens. So that could be an increase in cost. Yeah, and so you got to kind of factor that back in. You'll save some money though in other areas. For example, maybe you're not driving as much. Yeah, so. And you're not driving back and forth to work. I don't know. Maybe you're not doing that now anyway because there's so many people working from home. But obviously you have less gas and maybe clothes. You don't spend as much money, in clothes. I mean, I honestly see the clients come through the lobby that have similar style as to when they retired, because they're not wearing them out. They wear their nice clothes to come in and see me, but they don't have to rebuy those all the time for all their corporate meetings or whatever it is that they were doing, right? So, yeah, it's that's the issue. I once had a client tell me, at some point in your life you get off the fashion train, right? And your clothes cost goes down pretty substantially if you just keep wearing the same things all the time, right? Polyester lasts forever too. But so anyway, that's kind of what you look at. And what are the pluses and the minuses? The plus on travel and the minus on gas and the different clothing aspects, and what's happening with the taxes, what's happening with the overall scenario that happens with your savings that you probably won't be doing.
Yeah, I think it's a lot easier to, instead of trying to think about replacing your income, but thinking about how do I afford my expenses, my cost of living, or my style of living. And so that's what you should be looking for. And some other expenses that may drop off is, it's pretty common to have a goal to pay off your house by the time you retire. And so that's a big fixed income or fixed expense that can just drop off, that makes your life so much more flexible in retirement.
Yeah, that's a big one. We see a lot of people that if they haven't done it right at retirement or right before, they're on track to do it fairly soon thereafter, right? And so that's another, basically a cost that'll disappear. And yeah, they're all there. I'd say I'd see probably in that 70 to 80% of current income quite often. As far as that goes, the ongoing costs are, that's not a bad rule of thumb, but you can pretty easily kind of do some little figuring to kind of get it right. It is an important number to get right. When we do the financial plans, it's one of the more sensitive numbers. To go from 70 to 75,000, it takes a lot more assets to make that work, and so then you end up with this situation where you're getting that extra 5,000 every single year for the rest of your life. Plus, it's growing with inflation, so it makes a big difference versus buying a car every 10 years. It's not as even though it does go up in cost, it's not as frequent. It's not every year, right? That type of thing.
Yeah. So next question is, will inflation have an impact on my Social Security earnings at all?
Now, this is a good question. So Social Security has a cost of living increase. Now, they use a different basket. They call it, I forgot what it's called, but I call it a senior basket for figuring out how much your Social Security is supposed to go up. So when you hear CPI, that's the Consumer Price Index, that's the most well-known. There are a lot of different inflation indexes, by the way, but the most well-known is CPI. Most people probably know it went up 9.1%, last month versus the year before. But this special basket is what they use to figure out how much your Social Security grows. So this year, Social Security grew 5.9%. That's what they announced as the cost of living increase for 2022. It's announced in October. So October of last year, we knew it was 5.9% for this year. Unfortunately, last year they had an Alzheimer's drug that got approved really right before they were figuring out how much to charge for Medicare.
Yeah, so the Medicare B premiums jumped from about $148 to $170 per month.
For the lowest cost.
Yeah, just for the standard kind of premium. And a lot of that was because they were unsure of COVID expenses that came through with long COVID. And then also this Alzheimer's drug, they were initially pricing it at $56,000 per treatment. But after the announcement of the premium for the year, it has dropped to 24,000. So there's some expectation that there won't be as a big increase this year.
Yeah. So the rumors that we're hearing for next year are that we could have these are great rumors. We'll see what happens. October's not that far away. We'll find out for sure. But we could have a double-digit cost of living increase on Social Security, and we might not have as much increase in Medicare because they're readjusting to this drug and some of the other things. We'll see how that plays out. Because last year, Medicare went up about 15%. And for some people, they didn't even get much of a bigger check because Medicare jumps so much and it comes out of their Social Security. Those two kind of have to be hand in hand. But most likely, what you're looking at this year is a better scenario where your Social Security will have a better chance of actually keeping up with inflation. At least from a rumor standpoint, we'll find out some more. But it's a good question. It's a really important area, and it's a nice piece of the Social Security payout is this cost of living increase. I'm not sure that's going to stay around forever. If you're already getting it, you'll continue to get it, in my opinion. I'm not sure my kids will get it, right? Because they're talking about it's like anything else. They used to offer lifetime health care for teachers here in a lot of districts, but then people live too long. And so no longer, people are grandfathered in, but it's the same thing here. These cost of living increases are very expensive to Social Security, and so they might modify that, and I wouldn't be surprised, as a way to kind of make Social Security last, longer and longer and then be permanent, but, not have as many, questions hanging over it as we're seeing now.
Yeah, and especially for those people that are delaying Social Security that have already reached their full retirement, or they're going to see that 8% plus whatever cost of living adjustment.
Oh, yeah.
And so that could be a massive jump to just your benefit for planning purposes.
Yeah, just to be clear there, if you reach full retirement age and you do not take your Social Security, you get 8% increase in your Social Security that next year, plus you get the cost of living increase even though you didn't take it. So for 2022, if you're full retirement age or beyond, you are getting 8% plus the 5.9. You had a 13.9% increase in your Social Security, which is incredible. If next year it's 8 plus 10 or something, it could be 18%. We don't know what it is yet. We will shortly, but those are huge. And then so the more you delay it, you're getting that 8%, and you're getting a bigger number, and you're getting to compound off that bigger number for future, inflation increases, cost of living increases. Because again, although they might go after that at some point in the future, if you're about to receive Social Security and you're already past full retirement age, they're not going to adjust anything substantial on cost of living increase, in my opinion. They'll do it for more younger people, maybe even my age. To be honest, there might be some adjustments made.
Yeah, they're not going. The problem is you can't take away a benefit from people that are already getting the benefit. Yeah. It's a very hard thing because a lot of people plan or depend on these benefits.
Right.
And so if you take them away, you're basically putting people into poverty.
Yeah, and nobody wants to vote for that. So that's why we can hardly get anything through Congress as it is, and I don't think that gets through, as far as that goes. So at some point in time, they'll do some adjustments. The easiest adjustments to make are to people that currently aren't getting the benefits, and hopefully they do it so that people have, enough time to make an adjustment. I know Alan Greenspan used to talk about that all the time. He's kind of like, if you're going to make adjustments to Social Security, do it earlier. And make those adjustments so that the people are 20, 30, 40, and they'll have this long period of time to kind of, maybe save more than they might have because Social Security isn't going to be as good as it was for their parents. I agree with that wholeheartedly. Well, I don't know if that's going to happen, but that seems like a reasonable concept. All right. Well, that's another show here with Talk Money with Tom. Really, really enjoyed the questions that we have are excellent. So much fun to be able to cover all these. I hope that you get, some knowledge out of this. Again, you can send in your questions at any time. Feel free. I love to get these questions, and we can think about them. So send them to the email address here. You can, of course, subscribe to the channel. The more you know about retirement, how to manage your money, how to plan your retirement, how to reduce your taxes in retirement, I think the better your retirement's going to be. Even if you're working with an advisor, it just makes it so much easier the more somebody knows. And it's one of the reasons we started this channel with our clients. And obviously you can subscribe and hit the little bell if you want to get notified. And then lastly, of course, you can book an appointment with us to meet with, Easton and I, and basically have a chance to, talk to us individually. You go to the book appointment button on the website. There's a link to the website in the channel here, and pick a 30-minute phone or video call, and we'll talk to you and hopefully be able to help you out. So thank you everybody very much for coming. I look forward to seeing you next Friday. Thank you.